So as we think about 2026, there's a few factors at play. On the positive side, for the US economy, you have the fiscal loosening, which is a result of president's action and the one big beautiful bill. So that should be supportive growth. Another thing that you have going on is the capex on AI. We expect that to continue and be strong in 2026, another important factor. And third, we think consumer is actually in pretty decent shape. Balance sheets are healthy, asset prices are high, so wealth effects are strong. Consumers are likely to keep doing just fine. So because of these factors, we think US economy is likely to do better than worse and weather the storms of any tight trading conditions better. And what that means for asset allocation is that right now equities probably continue doing okay. And we are cautious about the number of rate cuts that the Fed is going to deliver. We think it's possible they might deliver less, which would be something that could be upsetting to US Treasury market.
How many rate cuts are you looking at for the year 2026?
Exactly the number, I would say it's unlikely they're going to get all the way to 3. So right now there's 1 in the price for December, and there's a couple of more, maybe 2.5 for the year forward. We think it's more likely the pricing is going to return back to 2 cuts in 2026. But, data might change. For now, data has been all over the place. It's really hard to get a proper pulse on the economy. But on balance, we think economy is fine, which means central bank doesn't need to rush to the rescue.
Okay, so there was the big debate of 2025 of whether AI stocks are overvalued, and now we are in a kind of AI bubble. Some are saying it's similar to what we've seen during the dot-com bubble. Some are saying it's not. So I would love to hear your perspective on that issue.
Well, that's one of those history doesn't repeat, but it rhymes. Well, it rhymes a little bit. In some segments of the market, you can see there's excess optimism and some stocks which are not overly profitable getting a bit of a bid. So I'll agree, there's some sympathies and valuations are quite expensive. But .com was underpinned by profitless companies without cash. Now, the companies that are at the forefront of the rally are profitful companies with a lot of cash, and they don't need to over leverage themselves to spend. So we're looking out for signals of excess leverage and over issuance of debt. That is an important thing to look out for in 2026. But for the time being, it's not the same as .com because their balance sheets are strong and because of the winning businesses being exceptionally profitable.
So other headlines during 2025 were focused around silver, gold, and Bitcoin, and the huge debate of whether gold will sustain its rally going forward in 2026, and that goes for the same for silver and Bitcoin as well. So I would love to hear your thoughts about it as well. What do you prefer in the portfolio for 2026? Having gold, Bitcoin, or silver, or a combination of the 3 maybe?
If you give me this choice, just between the 3, I would simply own gold and silver as part of the commodity basket, because I think they do have a place in the portfolio. On Bitcoin, don't really have a view. We don't allocate to it at this stage, and we don't really have a view on it going forward. So we don't view it as a component of portfolio at this stage. But on the metals, gold and silver, the fundamental demand is there, primarily from central banks when it comes to gold. But having said that, they've rallied quite a bit, and weak dollar has been supportive. And as we journey to 2026, we suspect dollar might take a pause in its depreciation, which means its underpin to the precious metals might be reduced. So a bit more cautious on that element. But central banks are still buying. And when central banks buy something, you kind of wanna be on that trade. So I wouldn't go so far as saying gold is gonna sell off. I would just say hold as much of it as you normally hold as part of your commodities exposure, and let it do its job as a diversifier in a portfolio.
So do you see $5,000 for an ounce of gold in 2026 by end of 2026?
I'll tell you this way. I think 5,000 is more likely than 3.
Let's engineer an investment portfolio for 2026. How much would you allocate for US stocks, for European stocks, for gold, maybe silver? What would you put in this portfolio, investment portfolio?
So as far as equities, we don't think it's time to be a major hero and make a major regional bet. So what I would recommend, and we recommend to clients, is hug the MSCI ACWI IMI, which is broad equity index. Just hug that and hold it long term. The one exception is a modest tilt towards Japan. And that is coming from a broad developed market equities, because we're quite bullish on Japanese economy, Japanese earnings, and the Japanese yen. We think Japanese equities is the place to be on a dynamic basis. So that's one thing that I would do in that portfolio you described. Hold gold and commodities the same way you would normally do as part of your strategic asset allocation. And then the one bit that we find more interest at this stage is in more niche ideas in fixed income. So UK gilts are interesting. I think that's going to be a narrative for next year. I would be a buyer of those. Frontier market debt, we think is very interesting. I would be a buyer of those. And Asia high yield is a very interesting asset class, attractive valuations, and I would be selling investment grade credit for that. So you can see we're looking for more niche, idiosyncratic risks rather than saying, this is the year for equities, this is the year for bonds, or this is the year for commodities. We think you want to be around neutral for those things and find opportunities under the bonnet in more niche opportunity sets.